Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Being an investor over the past roughly 3 or 4 years, I would probably say the number one thing that I get asked, the number one thing that I debate with friends or some of the audience members, a Discord server, we, sort of debate about these topics. I would say the number one thing, more so than is it a good time to buy this stock? Is this business a quality business? More than any of those things is valuation. It is arguably the most nuanced topic when it comes to investing, even down to the level of, is it something that is important for investors to pay attention to? Obviously, you have stocks like, for example, Palantir that just seem to be defying gravity, where it just continuously goes up hundreds of percent, seemingly without any end to it. And of course, it's not trading on fundamentals. It's not trading on any sort of valuation ratios. When this sort of thing happens, it just continuously goes up, right? And then you have the cases where people swear by, for example, the PE ratio as sort of the end all be all of valuation. It's the most important thing. Oh, this company has a high PE ratio, and so it must be expensive. And so this is a long overdue video where I continuously get asked by audience members, whether that be in the Discord server or on Twitter or wherever else, essentially how to do valuation. And, closely tied to that, which is kind of the conclusion of today's video and what I'm going to be eventually tying it into, how to find undervalued businesses by extension to that. I'm not some sort of expert here, but just based off of the past couple of years and my track record of continuously being able to find undervalued businesses, I kind of want to walk through my process when it comes down to valuation, what ratios to use, a little bit more nuanced than that, how to know whether a certain ratio works for a certain company, and so on and so forth. You guys will kind of understand as we go on here. And of course, to do that, I'm going on the world's greatest stock research platform, fiscal.ai, which you can get a 2-week free trial, no card required, using the link in the description down below. For starters, I want to look at probably, I would say once you get into investing, maybe the first 5 or 10 things that you kind of learn about, I'd probably say is like the S&P 500, and then you learn what the PE ratio is. And so to kind of start us off, the bread and butter evaluation is, of course, the PE ratio. Now, I've been on record saying that the PE ratio is flawed in many ways, and that's definitely true. The PE ratio is not some one-size-fits-all. There's a large umbrella of stocks, particularly mature businesses, that actually you could use a PE ratio for, and it's a good gauge of the valuation of that business, whether it's expensive or it's cheap or whatever the case is. But there's also a lot of flaws with the PE ratio. Now, for starters, where does it actually apply? Where is it a good gauge of valuation? I would have to say it's with mature businesses that have been profitable for many, many years. Of course, the bottom portion of that PE, the E portion, is closely tied with the profit margin of the business. And so it particularly works well when a business is very profitable and has been for a number of years. For example, a business like Costco, which, as a retailer, it generally has low margins, but it's been profitable for many, many years. It's been profitable for 30 years, whatever the case may be. You could also look at a case like Microsoft, for example, right? If we pull up Microsoft here and we look at the net profit margins of this business, you'll see that for the better part of 2 decades, they've had very healthy margins. Now, what you'll notice is there's actually 2 years in here where the net margins dip down to 13% and 15%. And what's funny about this is if you overlay the PE during those periods, you'll see that the PE ratio, particularly during this 4-quarter stint in late 2017 and 2018, all of a sudden the PE ratio skyrockets up. It literally goes vertical within 1 quarter to a 54. Now, you as an investor in early 2018, let's just call it, if you're looking at the PE ratio of Microsoft and calling it expensive just because it trades at 50 times earnings, you would be incorrect. That's not how you should be looking at it, because again, the margins were artificially low, I would assume due to maybe a tax deferral or something like that, some sort of gap event that occurred during that period. The margins of that business were thrown off, and as a result, the PE ratio looked optically expensive. And so this brings me to my point of the first issue when looking at the PE ratio. There's a lot of accounting events that can occur, whether that be a tax deferral, whether it would be, and it could work in the favor of the PE ratio as well, right? So we can look at this in the case of Google, for example, very recently. I think the most recent quarter, they had some mark-to-market gains that they recognize on their income statement for their SpaceX investment. So I wasn't able to actually locate it within the filing itself, but just doing a very quick Google search, you'll be able to see that in the first quarter of 2025, Google reported a massive increase in their net income. And we can visualize this, again, back over on Fiscal. If we simply pull in the net income and look at it on a quarterly view, you'll see that for that Q1, it looks a little bit artificially inflated. You have all these quarters that are kind of, growing in like a steady cadence up and to the right. And then all of a sudden you have this big boost in the net income. Again, it looks kind of artificial. It almost looks like a data issue. And of course, the reason for that is because during that quarter, SpaceX raised at a higher valuation. I think the business was valued at like 300 billion, and Google has a small equity investment in SpaceX. And so because of that, they have an unrealized gain in this company, which resulted in a $8 billion boost to their net income during that quarter. And so the number one issue with this is that that's not actual income that the company generated, right? That's an investment that Google made, many, many years ago. It's an unrealized gain on their equity position. And that there's a whole other element to it of we're in like a raging bull market, and these valuations are just going sky high. Is that deserved? All that type of stuff. I'm not going to get into that. But nonetheless, this is something that, as per GAAP accounting, you have to recognize that as a net income gain. And so this is the number one issue with this, is whether it would be to the benefit of the company, which in this case it is, because as a result of this, the trailing 12-month net income of the company is a little bit boosted relative to how much it actually is. It's boosted by only 8 billion, which isn't much. It shouldn't throw off the PE ratio too much. But you could imagine, if that gain was 30% of Google's net income, now it looks artificially cheap on a trailing basis. And so this is the number one issue, whether it would be to the gain of the company or to the deficit of the company, right, via a tax deferral or something like that. The trailing earnings of the business can look artificially inflated or could be understated as a result of equity investments in other companies, as a result of tax deferrals. We had another example of this where it threw off the trailing earnings of the company, I think roughly a year ago, for this software company, Paycom, which I used to own once upon a time. The CEO of this company, I think they hired like a co-CEO or something like that. And as a result of that, he gave up a bunch of stock options. Now, as per GAAP accounting laws, when your CEO who was promised stock options essentially forfeits those stock options, that's a positive net income event. Again, that's not actual net income that the business generated. It's stock options that would have been given to the CEO that are forfeited. So the net income looks like this, right? I think you guys are starting to get the idea here. If we overlay the PE during that period, I think as soon as that quarter was reported, the PE of the company dropped from like a 34 down to 24, simply because the CEO gave up some stock options, right? So this is the number one reason that I have a problem with the PE, is because you usually have to do a little bit of digging into the business, see if there's any irregularities with the financials. And if you look at, Yahoo Finance or Seeking Alpha or whatever, where it just presents to you the PE number, even on Fiscal, like on the overview page, we have the PE just as a number there. This doesn't tell the full story. Almost always, unless, again, it's like a super steady business to the likes of something like a Costco, a MasterCard, something like that, almost always there's something wrong with the PE. Very quickly, another example I could give you is Uber. This is a case of the tax deferral that I keep mentioning. In Q4 2024, they had a huge tax deferral that hit the bottom line. And again, you guys are starting to get the idea. This is on a quarterly basis. $6 billion of this is not earnings that Uber actually made. But then if you just simply look at the PE ratio, and I see this literally all the time, it grinds my gears. If people are like, oh, Uber is still so cheap, it's only a 16 PE. It's closer to like a 30 PE. If you factor in that tax deferral, it's closer to closer to a 30 PE. Yes, the business is cheap. It's not cheap because it's at a 16 PE, because at the end of the day, it's not. This tax deferral is not going to repeat next year. As soon as we lap that quarter, as soon as we get into Q4 2025, that tax deferral goes away. Almost certainly that trailing PE is just going to skyrocket. And yeah, you guys get the idea. So that's my gripe with the PE ratio and why it's just super flawed. Moving on, Arya, what is the solution? If we can't use the PE, what else should we look at? If you're seeing a situation where the trailing PE ratio is incorrect, again, due to the several reasons I just outlined, I tend to like to look at the EV to EBIT ratio. And so the EV portion of that, if you don't know, it just stands for enterprise value. Enterprise value is just simply taking the market cap, deducting the cash, and adding back the debt. So this is a means of looking at the business if, they paid back all their debt. And then, of course, the cash on that business, you could kind of essentially treat it as like an instant buyback, right? So this rewards companies that have a huge cash balance, for example, a Google, which for the larger part of the past 5 years has had about $100 billion of cash on their balance sheet, and it punishes companies that have a lot of debt. You could think of like AT&T or like any of the airline companies as an example of that. Realistically, we should all be using EV, but it's a bit of a more obscure metric. So anyways, and for most businesses, the debt and cash tend to be kind of similar. It doesn't make too much of a difference, right? The EBIT portion stands for operating income. And so if you head over to the income statement of any company, you have your operating profit, which is essentially just the profit the business makes before you pay your taxes or before you pay interest on your debt. And I like this one because it seems to be a little bit less volatile. You kind of strip out the issues that you have within the net income number. all the kind of funny stuff, the tax deferrals and, the stock-based comp issues and all that type of stuff, the equity gains that many companies put on their income statement, it doesn't hit the operating line. And then in addition to that, a lot of investors are worried about stock-based compensation, and rightfully so. It's an expense to the business that you need to take out when looking at any of the profit figures. And so operating income actually deducts that. So in my opinion, this is my favorite ratio to look at where applicable. Of course, in some scenarios it doesn't work, but for the most part, in my opinion, I think EV to EBIT is the most consistent, has the largest number of businesses, the biggest umbrella of stocks under it, and the ratio works in the most amount of scenarios because, again, strips out all the funny stuff that happens with net income. But even the EV to EBIT ratio isn't perfect. There's a lot of scenarios where it's better to look at, for example, free cash flows. And the best case I have for this is looking at generally software businesses or subscription businesses for the most part. And the reason for that is almost always when looking at a software business, what I like to call the income statement ratio, so whether it be PE or EV to EBIT, those tend to look a little bit more expensive compared to the free cash flow numbers. And the reason for that is because these software companies, for example, a Salesforce, or for example, Adobe, for example, right? They usually, not always, but they have a lot of subscriptions where they get paid upfront at the start of the year. So a Salesforce might get paid, let's just say $2,000 at the start of the year in January to provide the Salesforce software and the Salesforce license to their customer for the entire year. But what they have to do is if they receive that $2,000 up front, the cash has entered the business. That's money in the bank for Salesforce. Under GAAP accounting laws in the income statement, they have to report only $500 of revenue. They have to do it on a quarterly basis. This is called the revenue recognition law. And so with this is you only report that revenue once you've quote unquote earned it. You could think of it as the perfect example I like to give is if you book a hotel for next year, sure, you just paid for that hotel right now, or you paid for that flight for your trip to Paris, whatever the case is. I only use Paris because I was recently in Paris. But anyways, you pay for that Paris trip a year in advance. That airline or that hotel can't actually report that revenue as being their revenue until they've quote unquote earned it at the date in which you're going to that hotel a year out. So after a year, can they actually report that as revenue? And so as a result of this, you always essentially with a software business or subscription business, you have cash that is entering the business for services to be provided later. So when you look at, for example, the operating income of an Adobe and you contrast that with the free cash flows of Adobe, the free cash flows will almost always be a little bit higher than the operating profit. I think actually if we look at Salesforce, this is a little bit more evident of a case. Particularly with Salesforce here is they had a lot of stock-based compensation for the past, essentially their entire existence. And only in the past couple of years have they started to dial that back. So that is something you also have to pay attention here. Free cash flow isn't perfect because it doesn't deduct stock-based comp, but my point still stands. Almost always the free cash flow number is a little bit higher than the operating profit. Even in the case of for example, not really a software business, but Duolingo, a lot of people are on annual plans. So with Duolingo, there's a lot more cash entering the business as opposed to quote unquote earned net income. And actually they have a KPI on this for revenues as well. It's called bookings, total bookings. Yeah. So total bookings is all the revenue that has entered the business, right? It's not necessarily earned, but it's the revenue that has entered the business. And so you look at that and you contrast that with the actual revenue figure. Almost always the revenue figure for the company is a little bit lower than that total bookings number. So very quickly, just to take a breather and kind of summarize everything that we've been through so far. PE, you really have to do your homework on that one to actually be able to use it. It works in some scenarios. I do use the PE as a proxy of valuation in many cases, actually. But you kind of have to do your homework. You kind of have to look into the number a little bit, make sure that there isn't any funny things happening with it. EV to EBIT, again, great ratio, has a wide umbrella of businesses that it applies to, but that's also not perfect because you have some business models, namely subscription businesses or software businesses, where the free cash flows are the truer proxy of actual profitability for that business. And if I were to summarize this entire video, I would kind of state it like that. You ultimately want to find the ratio that has the true proxy of profitability or the true proxy of profits or revenues or whatever it is that business is generating. That's what you want to look at. And that's what you want to compare the market cap to whatever that profit number is. But in general, I tend to like to look at free cash flows if possible, if applicable. And then I like to look at EV to EBIT if that works as well. Now, of course, you have some cases, for example, Amazon, where free cash flows currently doesn't work. And the best way for me to kind of show you why it doesn't work is to look at this other ratio called capex to operating cash flow. What free cash flows ultimately is you take operating cash flow and then you deduct the capital expenditures that the business invested in. Now, if we get into a cycle where that business is investing a lot into capital expenditures, so, they're, for example, in the case of Amazon, they're building out a lot of data centers. They're building out a lot of warehouses for their e-commerce business. They're building out a whole bunch of office buildings, whatever the case may be. If we get into a cycle of they're ramping their investments into the business, that can artificially, temporarily suppress the free cash flows that the business is showing. This is the case with Amazon currently. If you look at the free cash flows of Amazon recently, you'll see in 2022, it actually dipped into the negatives before, skyrocketing back up in the 2024 period. And then over the past little bit, it's also, again, started to decline. The reason for this is because they're investing a lot for the future. They're investing back into their business to build those data centers, build those Amazon warehouses, so on and so forth. And this is particularly evident by looking at the capex to operating cash flow ratio. And you'll see that, they're starting to trend back up. They're starting to kind of ramp their investments back into the business. And so in a case like this, if you didn't want to use the EV to EBIT ratio, I would recommend just looking at price to operating cash flow. This is a bit more niche of a ratio to look at. It particularly works well for businesses that are investing a lot into CapEx currently. And what you end up looking at is sort of like I like to say, the profit potential of the business. Tying all the way back to what I mentioned earlier, of when you're looking at these type of businesses, you want to look at their sort of truest form of profitability, right? And so stage 2 of this video, I guess, is now that we've kind of identified what ratios to use, when to kind of rule them out, and when do they kind of typically work and all that type of stuff. Now I'd like to kind of talk about how to use this information. It's one thing to have, Amazon trades at a 30 PE, whatever the case is, but just having that number on its own isn't that informative. And so this is why I absolutely love a tool like Fiscal. I'm not even trying to be some sort of shill for the platform because I'm affiliated with them or anything like that. I genuinely believe in this product because it's almost it actually is a form of education for you. Gaining access to all these financials and all these ratios and having them, this is the key, on a historical time frame to kind of look at the trends over time. It is a literal form of education for you, and you're able to make great investment decisions off of that. For example, and I'll use an example where I use Fiscal to make an investment decision. It's worked out wonderfully for me. One of the primary reasons that I invested in Google in the 150s, my average, I think, on the business is 153. Yeah, my average on the company is 153. It's been by far my biggest winner. I'm up 60% on it. The reason I was able to identify that opportunity at the time was almost solely as a result of me having access to a tool like Fiscal, where I was looking at the PE chart, for example, able to pull it in on the past 5 years, past 10 years, whatever. And down here, when the company was trading in the 150s, I could see very clearly this is one of the lowest PE ratios that this company has traded at over the past 5 years, over the past 10 years, whatever. Trading at 15, 16 times PE, this is an irregular occurrence for this company to be this cheap. Obviously today, the company's trading at, 26 times earnings. It's not as good as an opportunity. But back here, when I was looking at it, and there's literal videos of me talking about this, by the way, so I'm not just talking out of my ass, but I was looking at this and noticing how stupidly cheap it has gotten relative to its historical valuation. Now, there's a million different ways to do valuation. You could run your projections and all that type of stuff. That's something that I do as well. But I find one of the most consistent methods of doing valuation is looking at where the company typically trades at, because ultimately your job as an investor is to kind of think in bets. What better way to do that than, look at historical financials and the historical prices in which this company tends to trade at. And so if you're looking at this, and you know for a fact that over the past decade, Google has averaged about a 27 times earnings multiple. It's currently trading at 17. That smells like opportunity to me. Even if we overlay my favorite ratio, the EV to EBIT multiple, the same could be said there. It was averaging about, average, median, whatever, 22 times EV to EBIT over the past decade. So when it's trading at 15 times EBIT, that's probably a good time to be buying into the business. Same could be said for Uber. Same could be said for ASML. That's another one of my big winners. It's up 40% in the past month. Now, I'm not perfect. Of course, I've made mistakes in the past, but I'm just showcasing to you some of my better buys have been me looking at the valuation chart over the past 5 years, over the past decade, noticing that it's trading on the low end. Time and time again, I said post 2019, sort of the relevant history of ASML. There's maybe 10 videos of me talking about this, by the way. Post 2019, when the company really started ramping up their EUV machines, over in April and in August, ASML was trading at the lowest valuation it has traded at. Now, your job as an investor in that moment when the company has gotten cheap is to identify whether this is a mispricing by the market and the same growth drivers that were present for the business over the past 5 years, over the past 10 years are still present. If they are, that mispricing is not going to last long. If ASML is still the same business, growing at the same cadence they've grown at for the past 5 years, the only difference is that the valuation has gone from 40 times earnings to 20 times earnings. There's no sort of disruption risk to the business, nothing at all. It's just the market souring on the company. That's almost certainly going to be a buying opportunity. Now, the case where, the line kind of gets a little bit more blurred and it's a little bit more difficult to make an investment decision like that is, again, for example, something like Google, because down here, the naysayers are out in full force. They're saying LLMs and ChatGPT is going to disrupt search, but then when the stock goes back up here, it rockets up 60% in a couple months. That's when it kind of becomes clear that no, AI is actually going to help Google. You have a case today, for example, Adobe trading at $340 per share. It's down, I think, 50, 60% from the all-time highs, trading at the lowest multiple it has traded at since 2008. Adobe currently trades at 15 times forward earnings. Again, lowest valuation since 2008. And currently the narrative in the market is that AI and video generation and all these new competitors that are coming onto the scene for creative software, they're going to disrupt Adobe. Adobe's going to zero, they're going to be bankrupt. And so that has some merit to it. In addition to that, the growth of the business has slowed down. So there's a couple different question marks that you need to answer as an investor before making an investment decision at these prices. But nonetheless, the point still stands. Looking at the historical valuation of the business over the past 5 years, 10 years, whatever the case is, however much history you can get your hands on, these are the charts that you need to see as an investor to be able to identify trends and be able to identify whether a certain stock is a good opportunity or not. And you can do that best over on Fiscal AI. Again, link in the description, 2-week free trial, no card required for you to give that a try. Now, very quickly, just so I'm not, misleading anybody here, I do want to mention this isn't a foolproof method. And I'll give you an example with Lululemon, for example. Looking at the valuation chart of Lululemon, it looks like every other stock I've pulled up over the past 5 minutes. The valuation has gone down into the right. Oh, it must be a great opportunity. It's the cheapest valuation since 2000 whatever. Look, Arya, the PE is below the COVID crash. Shouldn't that spell opportunity? Not necessarily. I do think Lululemon currently is undervalued, but looking at this, you shouldn't expect the company to re-rate back up to 40 times earnings, 30 times earnings, whatever. Why? The business has fundamentally changed. They've become more mature and they deserve to trade at a 40 PE back when they were growing their revenues by 20%. And so in general, everything else equal, when it was growing 20% and trading at 40 times earnings, when it grows at 10%, you should expect it to trade at a 20 PE for both those numbers to have. Now, in the case of Lululemon, this hasn't occurred. It's growing roughly at 10%, but in my opinion, the valuation has fallen off way more than it deserves. Instead of the valuation going down to 20 times earnings, it's currently at 12 times earnings. So I think this is a case of the market overly punishing a name like Lululemon because they have competitive pressures. They're facing, margin pressure with their premium pricing, so on and so forth. So there's an example of, simply looking at the valuation here doesn't really tell the full story. You also need to blend it with the growth. And so that brings me to my final point of once you've looked at the chart, once you've gone onto Fiscal AI, using the link in the description down below, created an account, tried out the free trial, all that great stuff. Once you've done all that and you see the numbers and you see the chart, you see that it's at historical lows, so on and so forth, you need to blend that number with the growth of the business. Otherwise, it's sort of meaningless. A company could be expensive at 15 times earnings and a different company could be cheap at 40 times earnings. It all ultimately depends on how fast we expect that company to grow. And more importantly, how predictable is that growth? And so in order to do that, I like to use what's called the PEG ratio, where it essentially just takes the PE and you divide that by the growth rate. Now this works with free cash flows. So you have price of free cash flow up top and you have the free cash flow growth rate on the bottom. It works with operating income. It works with anything you could really imagine. So what you want to do here, and I've built the spreadsheet that, I include in videos and whatnot, is you want to look at whatever multiple the business is trading at and divide that by the growth rate and kind of compare the various different companies here. So for example, I've done that with Adobe here, and we have a 17 times multiple. I expect the business to grow at about 16% operating income per share over the next handful of years. And so you'll see Adobe is actually one of the cheapest businesses on this valuation spreadsheet that I've built here. You have a case like, for example, S&P Global, where yes, the 24 times multiple doesn't seem too expensive, but the issue is the sort of slow-ish growth rate. Or you have a high growth name. You have Shopify, for example. They're growing at 30%, but their multiple is an eye-watering 118 times operating income. So when you kind of blend the two numbers and kind of compare it with everything else, you'll sort of be able to make a better investment decision and use your own judgment of like, how predictable is this business? Obviously, a business like Adobe currently with the narrative is it's trading that cheap relative to its growth because it's a bit of an unpredictable business. It might actually get disrupted over the next 5 to 10 years. Business like Uber, same story. It's actually gone up quite a bit from the start of the year. It's up like 60%. Despite that, it still trades at a pretty cheap EBIT to growth multiple. And then a little bit further down here, you have like MasterCard, where obviously it's a very, very predictable business. So it trades a little bit closer to a 2 times PEG ratio or EBIT to growth ratio, whatever you want to call it. And so here you're going to have to use your judgment a little bit. If MasterCard were to drop to like 500, or if it were to drop to say 450, right? And it trades at 1.5 times EBIT to growth, I would argue it's actually very undervalued at those prices because, again, MasterCard's a super predictable business. It's not a company that you're going to be able to get at super cheap prices or at a super cheap ratio, like, for example, an Uber or an Adobe. So I would argue that it's actually very undervalued for a name like MasterCard. But if Uber were to get up to those prices, I wouldn't be too inclined to buy into the company because it generally kind of trades cheaper than a MasterCard due to sort of less predictability, the bad narrative around it, so on and so forth. And so there you have it. I hope I've given you quite the masterclass on valuation and how to identify undervalued businesses. To kind of finish off this video, again, there's no foolproof way of doing valuation. Everybody has their own little nuances and gimmicks that they kind of apply to valuation. My best advice to you is to just go out there and make a bunch of charts on fiscal, do your own due diligence on stuff, do your own research and stuff like that. And then over time, you'll kind of start to get experience under your belt, learn all that great stuff, build your own intuition with these things. What I just mentioned about the comparison between Uber's predictability and MasterCard, you start to develop these sort of intuitions. And then lastly, one of the only ways for you to support me is to join the Patreon for the price of a coffee. We have a Discord server here. There's a whole bunch of exclusive videos. The idea for this video came from the Discord server. CPT Juke, one of our members, shout out to you, asked me about, does anyone have any good resources on how to study the valuation methods that Arya uses? One of our great members here, Maisie, kind of chimed in on that. There's a whole section here where you could go and read lots of value over on the Discord server, and we have these sort of debates and these sort of discussions all the time. We have over 300 members. Again, price of a coffee. We'd be more than happy to have you over there. And so with that, thank you very much for watching and have a great day.